Starting Monday, the People's Bank of China carried out targeted reserve requirement ratio cuts for eligible banks, the second such cut this year. That will release another 550 billion yuan, that's about $78.5 billion US of liquidity into the market. And besides that, a total of 100 billion yuan, or more than $14 billion, was injected into the market by a medium-term lending facility. So how do we find the timing of these monetary policies? What do they mean for the Chinese economy? And as most Chinese resume work and production, what is the prospects for the Chinese economy down the road? To talk about these issues and more, I'm happy to be joined by Jim Rogers, an international investor who is the author of A Warning to Japan, and Hong Hao, the chief strategist of the Bank of Communications International, and Professor John Gong from the University of International Business and Economics. That's our topic. This is Dialogue. I'm Zhou Yue. For starters, Hong Hao, how do you find the timing of the PBOC's recent monetary policies? The aim is obviously to injecting liquidity into the Chinese market.
Yes. The Chinese Central Bank has lowered the triple requirement, and also soon after the Chinese New Year, it actually injected 1.5 trillion Chinese yuan into the Chinese short-term liquidity market. So, all in all, if you look at the market interest rate level, has been going down in the past couple of weeks. It's an indication that the market probably has more than enough liquidity to go on. And also, I think, right now, the macro monetary policy may not be able to address, some of the structural issue that the market is facing. Basically, parts of the market wants liquidity, but not getting enough of it. But then, the broader part of the market seems to be in a liquidity abundant mode, because of the monetary injection.
And John, is this supposed to help those small and medium-sized enterprises? Some of them are run out of money, and some even run out of business.
Well, certainly it provides more credit into the market, which would definitely benefit some small and medium-sized business. But the issue really is not so much, in my opinion, not so much just associated with liquidity. I think the problem is that people are not going out shopping. People are not going out spending money, and the economy is not coming back yet. Mm-hmm. That is something that is more worrisome. The bottom line is that interest rate or monetary policy is not going to fight virus directly. We need to fight this virus first. I mean, that's the first priority, in my opinion.
And Jim, some central banks have also cut their benchmark interest rates to cushion economies from the outbreak fallout, including the Fed in the U.S. to cut rates to near zero. But the Chinese Central Bank remains steady, hasn't cut rates yet. Why do you think it's the case?
Well, the Chinese Central Bank has been doing a better job than the Western central banks. I wish you would go and run hours in Washington, because they know that doing absurd things like going to zero is not going to cure the virus. It's not going to cure the economy. It will help, and they have reserves for when there's a problem later on. This will help keep some people in business, but it's not going to solve the main problem now, which is the West.
What do you think is the main problem for the Western economy, including the U.S. and the European right now?
Well, Europe and America are the two largest economies in the world, and both of them are just now getting hit hard with the virus. They're just now closing down, so we're going to have to wait until they put in a lot of quarantines, a lot of tight measures to slow down the virus, and then once they slow down the virus, and whether that takes a week or a month, I don't know, then maybe they can start loosening up and starting to do business again. But the West hasn't closed down yet.
But President Trump is obviously afraid of a market drop that is dramatic 3 times in 2 weeks, and he obviously wants to blame somebody. Just yesterday he tweeted that the COVID-19 is a Chinese virus, saying it has affected the U.S. industries. So what kind of blame game do you think this is, Jim?
So yeah, don't you know Mr. Trump is never wrong? Don't you listen to him? If you don't listen, he will tell you. He's the smartest guy we've ever had, and he's never wrong. What's wrong with you?
So he's playing the blame game. You think so?
Yes, of course he is. And at the moment, it's easy to blame China and the Chinese.
But to the substantial economic issue, how much it will hurt a China-U.S. economic relationship if each other hate the others because of the coronavirus?
Well, it is absurd that people are sitting here blaming each other for a virus which is universal. In the past, we've had epidemics. You know, 10 years ago in America, we had the H1N1 virus. I didn't see people sitting around blaming America. The thing to do is to solve the problem, not to sit around calling each other names.
Let's talk about solving the problem. First, to the Chinese economy. The National Bureau of Statistics said on Monday the Chinese economy withstood the shocks brought by the COVID-19 epidemic during the first 2 months. But of course, you have to look at the data here, because the value-added industrial output, that's the factory output, fell 13%, fixed asset investment dropped 24%, and retail dropped 20%. So, Hong Hao, the economic picture in China is not that promising.
Yeah, probably the worst set of number we've ever seen, you know, since the financial crisis in 2008. You know, keep in mind that February is traditionally a very slow period, and also, you know, coupled with that, you have the virus spread. So, you know, we have a draconian quarantine measure in place, you know, to stop people from moving, and also, in part, stop people from going back to work until now. So I'm not surprised to see such pessimistic data coming out. I think going into March, you know, things are looking slightly better. I think going into April, you know, by the time everybody's back to work, you know, capacity utilization probably is going to go back to normal. But even so, you know, we're talking about a lost first quarter for the year.
So, John, the problem is, can we make up for the lost first 2 months of this year? Do you think the Chinese production will come back online fully, and it will make up for the losses we suffered in the first 2 months?
Well, let me first put the loss in the first 2 months into perspective, okay? You know, industrial output lost dropped by 13%. Service also dropped by 13%. So jointly, you know, these two sectors account for bulk of the GDP. So practically, we're talking about a GDP drop about 13% in the first 2 months. Now, we still have some good days in the first 20 days of January. Remember, you know, the lockdown was introduced in the city of Wuhan on January 20th. So, you know, taking into that effect, we're really talking about the worst case scenario for this virus is about, based on my calculations, about 22%, basically. This is the worst we have seen so far. And I think it's no doubt in my mind that we've put the worst behind us so far. Getting to March, things are getting better. But, you know, we have to remember, you know, how many, you know, Mr. Hong talked about draconian measures, but, you know, be it, you know, draconian measures save people's lives, right? You know, this is the cost we have borne so far, a 20% drop in our GDP, but think about how many lives have been saved, how many ICU trips have been avoided, right? How many people have avoided being sick as a result of this. So I think, you know, 20% drop in GDP is something we can bear with. It's something we're going to recover from. And moving into March, as we, you know, ramp up production, things are going to get better. It's not going to get fully better compared to the situation prior to the outbreak. But I think, you know, money and GDP is always something we can recover from. But lives, we can never recover from that. I think it's the price well paid for.
But people are doubting whether China has already turned the corner. But with many migrant workers returning to big cities, there is a chance of breakout somewhere. So, Hong Hao, do you worry that the Chinese economy may still have a lot of uncertainties down the road?
Yeah, I think no one has the complete picture of how the virus spread. You know, we haven't found the origin of the virus just yet. So I think the chance of a relapse, you know, of such a contagious virus is very high. So I think even though now, you know, seems to be under control, The problem is that, once you have migrant workers going back to the city, then you probably running a very high risk of a relapse of contagion. Now, keep in mind that, if you look at the metro traffic, for example, in the Tier 1 cities, they are at about 20 to 30% of the normal level, which is very, very low. If you look at the traffic going back to the first tier and the second tier city, it's running at about 60% of normal capacity as well. So what that means is that, what you're seeing right now is because of the draconian quarantine measure, you're seeing a sort of a contained virus spread picture. But then, once people are fully mobile, then the risk of a relapse of contagion is very high.
But even if those migrant workers have returned to the big cities, they're still facing an uncertain future because many of the jobs may already have gone. For example, those in restaurants and catering businesses, theaters, and entertainment. So should we worry about unemployment in a big scale in China?
I think for now, we haven't seen the complete picture just yet, But you're right, I've seen some initial estimates about 5 million jobs being lost already. That's quite a large number. And also there are anecdotal evidence showing that the graduates this year from college is finding it very difficult to find jobs, because companies simply not hiring just yet. So I think we're facing some challenges right now.
Jim, I think this applies also in the U.S. and Europe. Many people may find their jobs are not there anymore because of the coronavirus.
No, of course. Many of the jobs, especially in travel and tourism, are going to disappear for a while. So wait, how many people do you think are going to say in the next 5 years, I want to go to Wuhan? Not many. I mean, this is going to have some longer-lasting effects, not just in China, but elsewhere as well. Korea and Japan are two of your largest trading partners. They still are in decline. This is not over yet.
And what do you think the federal government in the U.S. and the central government in China should do if unemployment looms large?
Well, the only thing they can do is to have a big capital spending program, infrastructure. Everybody needs infrastructure. They can bring that back once the virus is under control, and it seems to be getting under control in Asia, then you can start spending programs. But don't do too much or you'll make things worse with too much debt and too much inflation.
That seems to be a dilemma for decision makers here in China as well, John. Should we boost those economic projects, boost investment and consumption by giving a lot of liquidity into the market?
Well, I think both monetary policy as well as fiscal policy should work together. I totally agree with Mr. Rogers that infrastructure project is something that we're going to do here. As a matter of fact, I know that some local governments throughout China have released plans for the next round of infrastructure build-out. Other than infrastructure in this case means more on the soft side of infrastructure, not just roads and railways, something more related to elevating the soft side of infrastructure in many cities here in China. This is definitely going to help. But I also want to make a point that the continued cases of the coronavirus is going to occur in China, no matter what we do. But this is not a reason of not taking these measures to stop it, and as drastic as we have done so far. Think about if we didn't do this. Think about if we adopted a strategy somewhat like the Boris Johnson was advocating, what's called a herd immunity. How much of a damage to the Chinese economy and to the rest of the world is going to be? How many people are going to die from this, right? So I think there's no doubt in my mind that we're doing the right thing. And we'll continue to the same way. I mean, we really have to fight this disease, this virus, continuously. We're going to open up factories. If there's an outbreak, we shut down that factory. It's going to be a fight block by block, factory by factory. It's going to be like this until the time that we eradicate this whole thing. And by the time that probably, hopefully, the vaccine is going to come out and we come up with a cure medicine for this. There's no easy way out of this. This is just a cost we have to bear. And I don't see any other way out from this mess.
And Hong Hao, physically, what do you think the government should do? Invest, export, spend?
Yeah, well, I think if you look at the history, there probably isn't that many choices that we can have right now. Consumption basically collapsed. Everybody's talking about supply shock. Nobody's talking about the demand shock. Retail sales in China plunged more than 20%, in February and January. In terms of exports, because of the foreign demand is going into shock as well because of the virus spread, so we can't hope on exports help to push GDP growth. Now, what that means is that what we have left in the toolbox is government spending and also infrastructure spending. Now, back in 2009, the 80% to 90% of the GDP growth is actually from fixed asset formation, right? So basically, we're talking about that kind of level of capital investment into infrastructure project to prop up the economy. And I think now the constraint really is that local government is heavily indebted. So I'm not entirely sure, the scale of infrastructure spending that they can engage themselves with this round, this time of the year.
But we are still living in the aftershock of the 2009 stimulus, 4 trillion yuan by the Chinese government. That led to over-leveraging and productivity decrease. Shouldn't we worry about those problems this time around?
I think so, because now, since 2009, the central bank's balance sheet expansion, is at the fastest speed of the world. We're basically expanding faster than the Fed, faster than BOJ and all that. And also, if you look at the debt to GDP ratio, is close to 300%. And I think in particular, if you look at the Chinese corporate and also the local governments, the gearing level is very high. I think central government is in a very good shape, and so probably there would be more increasing transfer payment from the central government to local government to help them to do some of the infrastructure spending. And also private families' gearing ratio is up as well because of the property bubble.
And Jim, Hong Hao just talked about the demand shock. Probably this will be a global problem in the coming month. What can decision makers and businesses do to boost the demand when everybody just wants to stay at home and do nothing?
Well, first, I would make sure you don't go deeper into debt, not at these times. But second, I would hope that the Chinese government would, you have a wonderful word in Mandarin, wei ji. Opportunity and crisis are the same thing. I would hope that Beijing would take this opportunity to make the currency convertible, make the markets open, the commodity and investment markets. This could be a great opportunity for China to bring in new money. There are many people outside who'd like to bring more money into China. I'm one of them. Use this opportunity. It might help.
Well, I want to talk a little bit about that because, of course, the American stock market has been plunging for the couple of weeks, and some people say, well, China's capital market might be a good place to place your money in. So you are obviously upbeat about this.
Well, of course, yes. The Chinese stock market's now, 50 or 60% from its all-time high. The American Stock Exchange was making a brand new all-time high in January. No, China's a much better place because it's more beaten down. You suffered the crisis earlier. You suffered the economic problems earlier. No, you're supposed to buy low and sell high. I know your parents taught you that.
Now, what do you think might be the Chinese government's chance of opening up further the currency market and the capital market to the outside world? Probably it might be a good chance.
Yeah, I think so too. I think the financial market opening is ongoing. I think since 2019, last year, because of our obligation, during the trade talk negotiation, basically we are accelerating financial opening. This year we're seeing foreign mutual funds setting up offices in China already, and many of them are actually starting to raise money, and also foreign brokers are entering into the Chinese market. So many things that we haven't seen before is already happening right now. Now, in terms of currency reform, we have to be a bit more careful, because if you remember, back in 2015, August 2015, when we initiated the currency reform in this round, basically it ushered in tremendous market volatility. So I don't think we can handle any more market volatility right now, because the Chinese currency is one of the more important currencies in the world, and it's going to be so. So
what about the argument of high risk, high reward?
Yeah, that's true, but it really depends on whether you have the appetite for risk. And I think for now, because the VIX, the market implied volatility, has surged to all-time high. We haven't seen this number at all in history. So I would say that you need a very strong appetite for risk to be able to tolerate that.
But considering the gap of interest... Yes, Jim?
I'm just going to say I have a high tolerance for risk in China.
You do?
This is 2020. This is not 1920. China is one of the largest and strongest economies and countries in the world. The currency should be convertible. This is not 1920.
But there is a gap of interest rate and also the prediction for risks. So investors will go with the flow. It is unstoppable. Probably some hot money will turn to China. Is this the right projection, John?
Well, these kind of things always happen. It's not just hot money coming in. There also could be an exodus of, Chinese money going to the rest of the world. So, these risks are always there. I think I'm of the camp that the currency market opening needs to be carried out in a phased approach. That's always the Chinese way of doing things. We always do try and error. If it works, we move one step ahead. If it doesn't work, we stop and think about it. So I think the kind of a scenario Mr. Rogers was talking about, the full convertibility of RMB, I don't think it's going to happen anytime soon. It's going to be some time away. We do have some measures taken already. For example, a lot of trades are already settled in RMB, for example, right? And also RMB, especially I think for trade with Russia and some other countries. And also RMB is increasingly being used as a reserve currency in some foreign countries. We have an offshore market for RMB, at least in Hong Kong. These measures certainly will contribute to the eventual full convertibility of RMB. An international market, but it's going to take some time there, especially I think at this point, we need to recover from this carnage, and a lot of things we have to do, I don't think we need to add one more layer of complexity immediately at this point. Let's try to fight this virus. Let's first clean up the economy, let people get back to work, let people get back to the streets and go shopping, Once the economy is in a much better shape, and then we can afford thinking about, and taking more courageous measures with respect to, especially with respect to the currency issue here.
I'd like to talk a little bit about trade, because China is still a big trading country. A lot of manufacturing are based here, but people say the coronavirus has given the world economy a big shock in terms of value chain allocation. Some people say this might result in dislocation of manufacturing bases elsewhere. What do you think, Hong Hao?
I think, in part it's starting. But keep in mind that the relocation of the supply chain is really at the low end of the supply chain. So basically closing shoes manufacturing, some of the manufacturing facilities are relocating to Vietnam and some Southeast Asian countries. But I think China is trying to remake itself into a high-tech, next-generation manufacturer, and it's already happening. I think Huawei is a very good example, and some of the semiconductor R&D efforts that we're engaging ourselves in are very good examples as well. So I would say that this is a supply chain upgrade rather than a supply chain relocation for China.
A little bit about the American stock market. Jim, the trading was halted as the S&P 500 plunged 7% Monday morning. That's a circuit breaker for the third time. You're an investor. What is your reading of the market in the U.S. in the coming weeks?
Well, sure.
Is it hit the
Well,
bottom?
you must remember that it's been 10 or 12 years since America's had a serious bear market in the stock market. So that's the longest in American history. So we're well overdue. It doesn't have to happen, of course, but we're well overdue. There are many dislocations happening in America. The debt's gone through the roof since 2008. So there are reasons that America could very well be entering a bear market, a real bear market, or even a recession, because it's been so long.
But Trump has been saying the fundamentals of America's economy is still very sound. You don't agree?
Yeah, well, no, I didn't say that. You're looking back. You know, you're always supposed to sell when things are looking great. That's when things turn around and go the other way. Nobody wants to sell when things are great, but you have to prepare that it's going to change. It always has, Shui. It always has, and it will again. You're saying it's not going to happen now. I'm saying it might.
And considering the fact that probably the Fed has already run out of ammunition, the interest rate is almost to zero, what can the Fed and the Trump administration do if the market continues to slide like this?
Well, they can do other things. They can start what they're doing in Japan. The Japanese central bank is buying stocks. The Japanese central bank is buying ETFs and bonds. The American central bank, it's not good. Don't think it's good for the country, but the American central bank can do the same thing. Mr. Trump can spend billions and billions more dollars, and he probably will because he wants to be reelected. They can do lots of things. Is it good for the country in the long term? No, but there's an election coming in November. In America, people don't care about the long term when there's an election a few months away.
And Hong Hao, if American and European economies come to a halt for a long time, what are the chances of this triggering a global recession?
I think there's no turning back already. Basically, if you look at last night's U.S. number, the Empire State plunged into a negative territory at the fastest speed. And also, if you look at the NY Fed, New York Fed's probability of a recession in the next 12 months, it basically has way past the 40% level that historically indicate a recession in the next 12 months. And also, the yield curve is inverting as well. So that's really bad for the financial sector. So I would say that, you know, the chance is not looking great for the U.S. and for the global economy. But I think right now, you know, we're trying all out, putting all stuff to fight back.
And John, people always say we will get worse before we get better. But how worse can we get?
Well, that's a tough question. I think it very much depends on how severe this virus problem is going to get into. You asked the question whether we're into recession or not. I think we already are. We're a couple of days into recession already. I don't think there's any turning back right now. This thing is not going to finish anytime soon. I think at least 2 to 3 months ahead. At least 2 months ahead, I think that United States and Europe will be very much like what we have gone through in February and in late January. So and with that, the economy is not getting any better. So if we wrap it up fast, probably this recession is going to last not very long. Otherwise, it's going to be a very prolonged recession. It's going to be a global recession, in my opinion.
Yes, indeed. It is an epidemic. If we cannot medically solve the problem, we cannot economically solve the problem. Thank you very much, Jim, Hong Hao, and also John, for your analysis. You've been watching Dialogue here on CGTN. I'm Zhou in Beijing. Thanks so much for watching. Goodbye.